Hey, good day, everyone. Welcome to our financial literacy webcast. My name is Bert Salazar, and I am going to be your host today. Now, we're getting closer to the end of the year. So today I want to do something that I do every 6 months because I do a mid-year one and then an end of year, which is what we call our end of year Q&A, questions and answers webinar. And the reason for that is that many of you, whenever you come to visit me, and we normally engage anywhere between 30 and 40 new clients a year. And on top of that, we do reviews on a quarterly basis with the vast majority of our clients. You know, there are a lot of questions, a lot of financial questions that people come to us in order to engage us upon and to try to get some answers to. Many a times, whenever we engage a client for the first time, we invite them to participate in a no cost and no obligation consultation with us. And those, we normally do either in person or we do over the telephone or through a video conference like what I'm doing with all of you right now. But obviously it's their 30 minutes. They can ask us any questions that they have in mind when it comes to financial management and so forth. So over the last several months, we have compiled a lot of these questions that come up on a regular basis. Obviously, we're not going to be discussing all of the questions because otherwise, we would be here for the next 2 hours or so, and I want to make certain that we can keep this short and concise by the same token. So again, my name is Bert Salazar, and I'm going to be your host this morning. And we're going to be sharing a lot of information that most of you are going to be able to take back and implement right away. And at least it's going to give you some thoughts that I feel are going to be critical and critically important for all of you as you start to prepare for retirement. You see, I have very close to 70 clients already in retirement, so that means that I have retired 70 times. Most of us, or most of you, will retire once in your life. Well, every time one of my clients retire, I also retire with them. And the reason for that is, as a retirement strategist, my number one goal is to make certain that my clients do their very best when it comes to retirement, retirement distribution planning, living a successful retirement life, not only for themselves, but also for their families and for their businesses, if they have any. So every time one of my clients comes to me and says, Bert, I'm going to be retiring in the next 12 months or 6 months, if these are clients that I have been working with for years, these clients are pretty much prepared for retirement. We may need to tweak a few things here and there, but at the end of the day, because of the fact that we have been working together for so many years, these clients find themselves in a very, very good position from a business perspective. So what I want to do now is I'm going to start. I wrote a lot of questions, so you're going to see here, but we're just going to cover what I feel are the major ones. And the first one that I want to cover with all of you is what are the issues to consider prior to retirement. Now, whether you're 5 years away from retirement, 10 years away from retirement, some of you may be 25 to 30 years away from retirement, but the vast majority of the clients that I engage are clients that are either very close to retirement, they may be 5 to 10 years away from retirement, and some of them are already retired. So I'm going to be talking to you about a 15-year period of what's important to do and issues to consider when it comes to retirement and preparing for retirement prior to that retirement date. Number one, it's about the accumulation rate. Retirement is all about the accumulation rate, making certain that you can put as much money as you possibly can, get an adequate rate of return on your investments, and we'll talk a little bit about that. But when it comes to preparing for retirement, the accumulation rate is very important. In other words, what kind of rate of return are you receiving from 1 year to the next when it comes to your investment accounts? The second issue to consider would be the contribution effectiveness that you have in the investments that you're putting away for retirement. Some of you may be participating in a 401k plan. Some of you may not have a 401k plan, but you're maximizing your contributions to an IRA. Some of you may be starting to invest in real estate. Some of you may have been investing in real estate for a number of years. So the contribution effectiveness, the diversification of that effectiveness, I think is going to be very critical in determining whether you're going to be successful in retirement or not. So it's not only the accumulation rate, it is also the contribution effectiveness. Number 3 would be your asset allocation. If you're invested in an IRA or if you're invested in a 401k, having a proper asset allocation is very, very important, because at the end of the day, you don't want to have all of your eggs in one basket from a business perspective, because there's a lot of volatility. Now, not only do I talk about asset allocation within the accounts that you're investing in, but also I'm talking about asset allocation from an investment diversification purpose. And what I mean by that is by having an annuity program in place for yourself and your family, by having a real estate program in place for you and your family as well. Whether you decide to start to invest in small apartment buildings or in commercial real estate, obviously some of you may be too conservative to consider those things. But one of the things that are critically important to understand is that when it comes to retirement, it's all about cash flow. And we'll talk a little bit about cash flow in the next few minutes, but cash flow is king. So when I talk about asset allocation, I am talking not only about diversifying, like if you're in a 401k, making certain that you have diversification in the funds that you have money in those 401ks, but also to diversify the different types of investments between annuities, real estate, perhaps some stocks, bonds, or whatever that may be along those lines. And then obviously, last but not least, is having the consistency to making certain that you do it day in and day out. Now, some of the clients that I have engaged in the past try to maximize their retirement planning all at once, and then for some reason or another, they have to stop halfway along those lines. I'd rather you be more conservative, invest less money, but do it on a consistent basis, because if you have time on your side of the ledger, then there's a very high probability that you're going to accumulate quite a bit of assets when it comes to your retirement distribution planning. Remember, if you're making $75,000 or $100,000 a year and you do that for 30 years, you're going to be earning anywhere between $2.5 million and $3.5 million in your career or in your lifetime. But it's not so much how much money you earn, is how much money you keep and what you do with it. So you have to be someone that is going to be methodical in what you're going to do for your retirement in order to make certain that you stay very focused and you make those consistent investments day in and day out in order to maximize the future. Savings is nothing more and nothing less than a postponed expenditure. Because we put money away in retirement, we avoid spending that money today in order to have it available at some point in time in the future when you're going to be spending that money to maintain your standard of living and that of your family as well. So I think those are the critical issues to consider when you are preparing or when you are just prior to retirement within a 5 to 10 year period. Now, if you have 30 years prior to retirement, then that's much better. Why? Because you have more time to be able to accommodate and to be able to do tax planning in order to make certain that you don't run out of money before you run out of life. Now, the second question that I get asked often is if Issues to consider prior to retirement are very important. Issues to consider at retirement and post-retirement are also extremely important as well. And the first thing I want to share with you, once you get to retirement, everything changes. You have to make a paradigm shift. Number one is no longer about the accumulation rate. It is all about the distribution rate. So the higher the distribution rate that you can obtain in your cash flow and the cash flow on your investments, the better off you're going to be in the future from a business perspective, in order to mitigate some of the eroding factors that we will be discussing in the next few minutes. The second point when it comes to issues to consider at retirement would be the sequencing of returns. And that is very important, because if you don't do it properly, you may run out of money before you run out of life. You see, when you're putting money in your 401ks and your IRAs, and you're still fully employed, and you don't need access to those funds, and not only are you making contributions every year, but if you work for an employer that gives you a match, they're also matching your contributions up to a certain percentage. If you do have any sequencing of returns, or you have market volatility during that period, you know, many of you in 2008 lost a lot of money. Your 401k probably became a 201k because of the fact that some of you may have actually lost 50% of your investments in retirement. But because of the fact that you didn't need that money in order to make ends meet, in order to maintain your standard of living, you could allow that money to recover. And because of the fact that you were still making contribution, you were in fact accelerating that recovery for the number of years prior to retirement. But when you get to retirement and you're no longer making contributions to your retirement program, and you can no longer wait for those investments to recover, because you need to start taking money out every single year in order to enhance and maintain your standard of living, now everything changes totally, because the sequencing of returns, as a matter of fact, if you go 2 or 3 years with negative returns, just when you start retirement and you actually need to continue to pull money out, then you get a double whammy. Because not only are you pulling money out of accounts that are losing value every single year, but you also have to pay taxes most of the time on those accounts. So you may actually run out of money anywhere between 11 and 13 years sooner because of the sequencing of returns and the negative market volatility than if you didn't experience those 2 to 3 years of market losses early on. Again, if getting old is bad, getting old and running out of money is even worse. So you have to take a look at the sequencing of returns as you're approaching retirement. The closer you get to retirement, the higher the susceptibility and the risk that you're going to be facing when it comes to retirement distribution planning. So it is very, very important and incumbent upon all of you to make certain that you look at your asset allocation and you find vehicles that can provide principal protection where even if the market were to correct itself, and we've seen a lot of market volatility in the last 3 months in this market that we're living in today, as long as you have accounts that are growing on a tax-deferred basis and your principal is protected, then obviously you don't have to worry that much about the market volatility or the sequencing of returns. But if you're not in those types of accounts, then you need to pay a lot of attention to whatever it is that the market is doing and whatever it is you are doing from a segmentation perspective when it comes to your investments. The third area to consider at retirement is longevity planning. One of the things that I share with many of my clients as we prepare for retirement is that they have to be able to plan for 3 decades in retirement. So if you're someone that retires in the mid-60s, you need to be able to prepare for 3 decades in retirement. Now, what happens if you're a public employee, if you're in public safety, police and fire, and you get to retire in your mid-50s or early 50s? I don't care if you have a pension from the organization that you work for so many years. There's a very high probability that pension, even with a COLA or cost of living adjustment, is not going to be able to keep up with the inflationary forces that are going to be attacking your money every single year. So whenever you do any type of longevity planning, you have to consider preparing and planning for 3 decades of retirement income and or cash flow. That is easier said than done. Now, when it comes to longevity planning, and we'll talk about that in the next few minutes, you also have to consider long-term care because it goes hand in hand. The longer you live, the higher the probability you and your family are going to have to have a susceptibility to long-term care, but we'll discuss that in the next few minutes. So again, longevity planning, making certain that you don't run out of money before you run out of life. And how do you do that? Well, you need to set up accounts that will give you guaranteed cash flow for the rest of your life. For instance, Social Security, for the vast majority of us that are on this call today, is pretty much guaranteed. All we have to do is to wake up on the green side of the grass, and if we do so, then we're going to be getting a paycheck from Social Security. If you happen to work and have a pension, unless something were to happen to that pension system or to the company that is providing the pension, then you can pretty much rest assured that as long as you wake up every day on the green side of the grass, you're going to have a check that's going to come in. So making certain that there are more guarantees and guarantees that provide a guaranteed cash flow is something that is very important for all of us and all of you to consider along those lines. Obviously, long-term care is critically important. As I said a few minutes ago, the longer you live, the more susceptible you are going to be for a long-term care event. Now, long-term care is very costly. Long-term care is something that needs to be planned. Now, what I do find is that if it wasn't for paying the premium for a long-term care policy, every one of my clients would love to have long-term care. And the reason why I say that is the following. Let's say that you're age 50 or you're age 55 or your age is 60 and you want to buy a long-term care policy. Now, long-term care policies you're going to purchase is going to cost you anywhere from 2 to 3% of your gross income. And obviously, they're very good policies because at the end of the day, if you cannot perform 2 of the activities of daily living, whether it comes to bathing or continence or eating or things of that sort, as long as you cannot perform 2 of those activities of daily living, or ADLs as they call them, then you would qualify for long-term care. The challenge that many of my clients have is they'll say, well, Bert, what if I purchase a long-term care contract at the age of 55 and I'm now 85 years of age and I die in my sleep? What happens? Well, what happens is that all that premium that you pay for those 30 years, you have just lost. Not only did you lose that premium, but you also lost the opportunity cost of that premium, because if you had known that you were going to die in your sleep and you were not going to have a long-term care issue to deal with, then had you invested that premium into an investment account earning anywhere between 4 or 5%, perhaps that premium would have generated somewhere around $115,000 or $120,000 that you would have on your side of the ledger to maintain your standard of living that you no longer have. Now, because of that issue, many clients are reserved and they're worried about purchasing, a long-term care policy that they may not need in the future. Now, because of all of those issues that I have just talked about, some insurance companies have come out with annuities, which are primarily designed for retirement distribution purposes, that have critical illness and/or long-term care riders assigned to them, meaning that if you purchase an annuity for retirement income and all of a sudden you have a need for long-term care and you qualify for long-term care, that income will double in order to offset the additional long-term care expenses. Now, if you die in your sleep, whatever money is left will then go to your beneficiaries at that point in time. Also, certain insurance companies have actually added critical illness protection and long-term care riders to their life insurance policies. See, most people, when they get into their mid-60s, they start thinking that perhaps they don't need life insurance anymore, although I can argue that everyone is going to own life insurance in retirement. Either you're going to pay a premium for it or you're going to be self-insured. But think of it this way. If you have a life insurance policy that not only provides a death benefit in case of a premature death, because no one ever dies at the right time, but it also has a long-term care rider or a critical illness rider that may allow you, if you qualify as not being able to perform 2 of the activities of daily living, it actually allows you to start using your death benefit while you're alive in order to mitigate the additional cost of long-term care services. So if you buy one of those 2 products, either an annuity or these types of life insurance contracts, someone is always going to receive a benefit. If you have a life insurance policy and you're 55 years of age when you purchase that contract and you die at the age of 85 in your sleep, then obviously your beneficiaries will receive the death benefit free from any type of federal income taxes. But what if you had a need for long-term care? If that was the case, and let's say you had a need for 2 years of long-term care, and that $500,000 death benefit is now worth $250,000 because you used 50% of it. 50% of it during your long-term care needs, and then you pass away, the additional or the remainder $250,000 will then go federal income tax free to your beneficiaries as well. So I always want to make certain that if my clients get what they want, they shouldn't have a cost for whatever it is that they're trying to accomplish. So by having these types of annuities and these types of life insurance, you're able to mitigate a multitude of different issues with every dollar that you put as premium or contribution into these vehicles as well. And when it comes to 7702 plans, which are the cash value life insurance, obviously there are many other benefits that we don't have the time, including tax-free retirement distribution planning that we don't have the time to discuss today. So again, long-term care, it's a very critical aspect of any type of retirement planning that you may consider doing in the future. Sadly enough, the vast majority of the clients that I engage, although they may be closer to retirement than not, they have really never taken into consideration the issues of long-term care. And with that, in the long-term care section, let me leave you with the fact that if you don't have a long-term care protection and you have a need for long-term care and you have no other choice but to pay for those long-term care benefits from your assets, under the IRS rules, you're going to have to go into what is known as Social Security pay down. which means in long-term care pay down, which means you're going to have to start to pay down or Medicaid spend down, as they call it in many states, where you're going to have to spend down your assets. And then very little is going to be left for your surviving spouse. So even if your surviving spouse thought that he or she was going to have a free and a very successful retirement plan, that may not be the case, because in most states, and the survivor of someone who passed away and went into Medicaid spend down, and the rules change from one state to the other, is that the survivor is going to be left with one home, one car, anywhere, I think it's anywhere between $100,000 and $115,000 in an account. And then they're going to get a minimum maintenance allowance, which in most states is going to be approximately $2,500. So you could have had $1 million, $2 million in retirement assets, and if you use the vast majority of that, because it has to be used first, then you're pretty much disinheriting your surviving spouse from that perspective, unless you do proper long-term care planning. I can go 2 hours just on long-term care planning, long-term care protection, and the vehicles that are surrounding those different risks, but I'm not going to do so today. So the other point in issues to consider retirement is disregard retirement. You know, many years ago, people thought about retirement. You get to age 65, you're going to retire, you're going to live another 5 to 7 years, and then you're going to die. Well, that no longer happens. Remember, I said you have to plan for 30 years in retirement. And I have a number of clients that don't do anything in retirement. And when you don't do anything in retirement, you're dying from a mental standpoint. You're not being active. You're not being productive. I forget the name of that beautiful lady, the actress, who's 94 years old and still performing. And she's been around forever. She's been an actress for many years, and she has no reason to stop working whatsoever. I'm 62 years of age, and I don't plan to retire ever, because if I were to retire, I would feel that I would die a lot sooner. Now, by the way, there's a big difference between working because you have to, as opposed to working because you want to. So when you get to your retirement years, you want to be in a position where you're going to continue to work, perhaps not on a full-time basis, but on a part-time basis, but you're going to do so because you want to stay active, because you want to stay productive, as opposed to just sitting at home and doing absolutely nothing most of the day, and just trying to wake up every single day on the green side of the grass. So again, those are issues and concerns that need to be taken into consideration when you get to retirement age. The next question that I get asked often is, you know, what is the impact of taxes and inflation on retirement income? And that's a very critical point, because, you know, our specialty is creating tax-free retirement life for our clients, and longevity planning for our clients as well. And we are also an accounting firm, so we do tax preparation and we do tax planning. But there's a major difference between doing tax planning and doing tax preparation. 99% of you on this call do tax preparation. Either you use a tax preparer, or some of you may want to do it yourselves. Now remember, you're always going to get what you pay for. So if you just do tax preparation, that means you will never, ever be prepared for retirement. Because in order for you to prepare for retirement, and to do so the right way, you have to be able to do tax planning. And there's a major difference between tax planning and tax preparation, because tax preparation only takes place between January and April. Tax planning takes place throughout the entire year. So it is very important that one takeaway for all of you is to stop thinking about tax preparation and to start thinking about tax planning, because if you do proper tax planning, You're going to minimize your tax liability in retirement. You're going to be able to offset inflation because you're reducing your tax liability, and those dollars are going to increase your cash flow in retirement. So if you've never done tax planning, I'm going to make an offer to all of you at the end of this webcast in which you can take advantage of it, but it will be entirely up to you. But the one takeaway is start doing tax planning as opposed to tax preparation. The next issue to consider is the fact that inflation is not tax deductible. And it's very critical to understand that, because if inflation is at 3%, depending on your tax bracket, you may have to earn 4 in order to meet an inflation rate of 3%. And by the way, inflation simply means, and a lot of people are confused about what inflation means. It really means that, you know, $1 today is only going to be able to buy 97 cents worth of goods and services next year at a 3% inflation rate. And the other way to look at it is that $1 today, in order to stay in line with inflation, would have to earn at least 3% next year and get to $1.03 in order to stay in line with inflation along those lines. But the vast majority of my clients fail to understand that inflation is not tax deductible. So where do you suffer the most in inflation? Well, when you have monies in CDs, money market accounts, savings accounts, because although the money in those accounts do not have the risk of market volatility, they do have an inflationary risk that could be just as bad as the market volatility that everyone considers from a business perspective. Now, inflation is much higher than most people think. And when I have a discussion regarding inflation with my clients, I look at it from 2 perspectives. One is the global inflation rate, which is the one that you can see, the CPI, the Consumer Price Index, which, by the way, the CPI in most terms do not include the price of food and energy. So obviously when they'll give you a 3% inflation rate, it's actually a lot higher because they're not taking issues like food and energy into consideration, and the fluctuation in pricing for those items can be quite high as well. But not only do we have a global inflation rate, but each and every one of us, each and every one of you also has a personal inflation rate. Some of you are more spend more than others. You know, there are spenders and there are savers. And then even amongst the spenders, you may have some people that, you know, will like to drive a Mercedes, and they're either going to buy a Mercedes or lease a Mercedes. So the lease payments or the cost of acquiring that asset is going to be a lot higher than someone that, you know, would rather drive a Ford or a Jeep or a Chevrolet. So again, both automobiles can take you from point A to point B, but the personal inflation rate and how do you manage your assets will determine which one is more critical for you, whether it's going to be the global inflation rate, because I have clients that they actually spend 2 to 3 times the global inflation rate. So for them, managing the personal inflation rate is very, very critical from a business perspective. The next thing is, where will taxes be in the future? Obviously, it is my feeling that taxes are going to be much greater in the future than they are today. You know, if you take a look at the national debt in our country, is fast approaching $22 trillion. Just to maintain that debt, so far this year, we have paid over $330 billion in interest just to service the national debt. That's a major, major problem. And also remember that the U.S. government, the only way that they can generate revenue is by taxing each and every one of us. Yes, I know that under President Trump, there's been a tax reduction, there's been an increase in the standard deductions, but that's only for 8 years. So everything is going to sunset on December 31st, 2025. When you wake up on January 1st of 2026, taxes are going to be a lot higher than in the previous 8 years. Now, the other thing is that is very critical to understand is that not only is it national debt a big concern for all of us that are tax-paying Americans in the United States, and I did say tax-paying Americans because approximately 40% of Americans do not pay federal income taxes. So that's something that you need to be aware of. But also the unfunded liabilities is even worse. And the unfunded liabilities are monies that the US government has already made a pledge to Americans that they don't have the money or the funds to be able to pay for today. Now, the unfunded liabilities take into consideration the liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt. And those are sitting at $115 trillion today. Yes, you heard me right. $115 trillion today. So I am one person and one retirement strategist that will tell you that there's a very, very high probability that taxes are going to have to double in the future, or our country is going to go bankrupt. Now, I not only say that, David Walker, who was the Comptroller General of the United States, and he was the head of the GAO, which is a General Accountability Office, said in 2008 that if taxes if our country continued to go in the route that it was going back then, and it has continued to go along those lines, that taxes would have to double, or this country was going to go bankrupt. So you have to prepare for high inflation and high taxes. You also have to prepare for 3 decades of retirement distribution planning. So for those of you who are doing tax preparation, forget about that, because you're digging a grave. You have to do tax planning in order to mitigate all of those issues that I have just talked about. The other thing to consider is that in retirement, you're going to lose the vast majority of deductions, exemptions, and credits that you currently enjoy today. Because if you're working today, you're making contributions to your qualified plans, you know, your IRAs, your 401k, so you're taking a deduction, is reducing your taxable income. If you're making a charitable contribution, you're obviously is also reducing your taxable income. By the same token, if you own a home, obviously the interest the mortgage interest deduction is helping you reduce your income. But once you get to retirement, either your home is paid for or close to being paid for. So the vast majority of the mortgage payments that you're making is going toward principal and not toward interest. So you're not going to have a major deduction, if any whatsoever. Obviously, you're no longer going to be contributing or making contributions to a qualified plan. So therefore, you're not going to have those deductions. And then if you were used to making charitable contributions, the minute that you retire, because of the fact that now you have time on your side, you're going to be switching and changing from making charitable contributions money-wise to devoting more time to those organizations. And the IRS will not give you a tax deduction for your time. So even if tax rates, which I don't think will be, I am certain that there will not be, even if tax rates were to stay the same as they are today, your tax deductions will go away, and therefore your tax liability may be higher in retirement. The only way you're going to be in a lower tax bracket in retirement is if you have been a financial failure for your entire life. Now, another question that I get asked is, when does it make sense to trigger Social Security benefits? And there are a lot of issues. One of the things that we do for our clients is we do, you know, Social Security reporting, and we do all the calculations for reporting. Family history plays a major role. Do you have longevity on your side of or your family? You know, how old are your siblings? How old are your parents? Are they still alive? How long did they live? How about your grandparents? How long did they live? So the longer the longevity, the more you could delay your retirement distribution planning. The second issue to consider there would be the income needs. You know, some of you may need to start dipping into your Social Security benefits sooner than later. You can retire as early as age 62, it take a 25% reduction in your income, or you can delay retirement until age 70, where you would take, depending on what is your the year of your retirement age, you can delay retirement and pick up another 24 or 32% of additional income in retirement. Now think of it this way: if you retire at 62 versus someone retiring at age 70, that means that the person at 62 collected 8 years of income, where the person at 70 is just starting. So the key ratio there is going to be where's going to be the break-even point, and also the mortality on your side of the family and your personal mortality that could determine what would be the best time for you to pull the trigger on your Social Security benefits. Another consideration, which is very exigent from a business perspective, and the vast majority of my clients never pay attention to, is the issue of provisional income calculation. You see, Social Security benefits all by themselves are not taxable. What causes the taxation of your Social Security benefits is not the Social Security benefit itself, is all the additional income that you may have coming to you every single year as you prepare to file your taxes. One of the things that we do for our clients is we do provisional income calculation planning. And by the way, those of you that are working with accountants or tax preparers, or those of you that are doing tax preparation yourself, you probably never heard of provisional income because you haven't done any tax planning whatsoever. And provisional income calculation is what determines what percentage of your Social Security benefits will be taxable in retirement. In a perfect world, that percentage would be 0. That means you did tax planning, you prepare for retirement, and you did it the right way. If you did it halfway, 50% of your Social Security benefits will be taxed in retirement. If you did no planning whatsoever, and you did a horrible job in your tax planning for retirement, up to 85% of your Social Security benefits will be taxed. And that's extremely important to understand. And by the way, what's even worse than the taxation of your Social Security benefits, those that pay taxes on Social Security benefits run out of money anywhere between 5 to 8 years sooner than those that don't. And the reason is simple. If you have to pay an additional $4,000, $5,000, $6,000, $7,000, $8,000 in taxes because of the provisional income calculation and the taxation of your Social Security benefits, you're going to have to pull that money from somewhere else because you need to maintain your standard of living. Therefore, you may have to take that additional money and deplete your retirement accounts even further in order to offset the tax liability of your Social Security benefits. So it is very critical to understand and very important to understand how provisional income calculation will come into play. So anything from any part-time work that you may have in retirement, any distribution from your qualified plans, your IRAs, and all of those things are going to come into play. Any capital gains that you obtain in a given year, either the sale of a stock or a real estate property or whatever that may be, will be factored into that. And then last but not least, the interest that you generate from municipal bond funds will actually be a negative, will have a negative impact to your tax planning and your provisional income calculation planning. The other thing to understand regarding Social Security benefits is your spousal benefits. You know, most of the clients that I engage, obviously once we engage these clients, things kind of take a turn for the better. But most of the clients that I have engaged have never done Social Security planning. And one of the critical aspects of that is that, you know, if you have a husband and wife and they're retired, they're both collecting Social Security income, the first spouse passes away, the surviving spouse has a choice to take the higher Social Security benefit. So if the decedent spouse had the higher Social Security benefit, now the surviving spouse gets to pick that benefit moving forward. The problem is that although he or she picks the higher benefit, one of those benefits is going to be lost forever. So if you're now paying taxes on those Social Security benefit distributions, and on top of that, the first spouse were to die, and now that additional benefit is lost forever, now you may very well run out of money anywhere between 13 and 17 years sooner than you would have done otherwise if you had properly conducted a tax planning assessment of your provisional income calculations and you had put together a Social Security spousal replacement plan in place prior to the first death. So again, when it comes to Social Security benefits, most of you make a decision through a microscope. I make decisions, or I recommend decisions to my clients through a telescope because the view is totally different. We're almost done. Another question that I get often is key ideas for a successful retirement. There are three that I'll give you very quickly. Number one, you need to be able to manage your IRS tax buckets. And I do a lot of public speaking. I also conduct public seminars. We do have a podcast channel. We do webinars. We do these webcasts for all of you because we're true believers that the more education that we provide, the better. I am a member of SOFA. SOFA is the Society for Financial Awareness, which is a 501c3 organization, nonprofit, and our job is to provide financial education to all of you so you can better yourselves and your families and your business when it comes to retirement. But the first thing I'll let you know is make sure that you manage the IRS tax buckets, and there are three of them. You have the taxable bucket, the tax-deferred bucket, and the tax-free bucket. The taxable bucket, it's taxed every single year, so you have to have a maximum number of dollars in that bucket. It does provide a lot of liquidity, so it's important to have the taxable bucket, but you need to be able to manage it accordingly. The tax-deferred bucket, most of you know, which is where your 401ks and your IRAs and your other qualified plans lie. The money goes in pre-tax, it grows tax-deferred. When you pull it out, you got to pay taxes on the whole thing. And because of the fact that taxes are going to be a lot higher in the future and the fact that you're going to lose many of your deductions at retirement, you also have to be cognizant of the fact that you need to have a specific number of dollars in the tax-deferred bucket, because if you have more than what you should, then now you're increasing your tax liability not only for that bucket, but also it increases your tax liability for your Social Security benefits and also for the Medicare premium that all of you are going to have to sign up for when you get to the age of 65, which is something that all of you and all of us need to do. I guess you're understanding now that retiring is not as easy as most people think. And when you look at tax planning, now you're starting to comprehend the importance of tax planning in planning your future and that of your family. And then the last bucket, so we have just mentioned the taxable bucket very quickly, the tax-deferred bucket. Then the last bucket is the tax-free or the tax preferred bucket, and that is a bucket where the money goes in after tax, the money grows tax deferred, but then you can pull it out tax-free. There are only 4 vehicles that fit into that bucket. You have your municipal bond funds, you have your Roth IRAs, you have your Roth 401ks, and your 7702 plans, which are your cash value life insurance plan. Out of the 4, only 3 are totally tax exempt, and those are the Roth IRAs, the Roth 401ks, and the 7702 plan. Remember that I said that the income coming out of a municipal bond fund, although it's federal income tax-free to you, that income or that amount of income is going to have a negative impact because it's going to have to be added on to the provisional income calculation in order to determine what percentage of your Social Security benefits will be taxed in retirement. So because of that, we don't consider municipal bond funds totally and fully exempt from a taxable perspective. So having the right balance between your taxable bucket, your tax-deferred bucket and your tax-free bucket is going to be instrumental in determining your success and failure and your ability to mitigate the eroding factors in retirement like taxes, inflation, stock market volatility, interest rate volatility, personal inflation, global inflation, propensity to consume, lawsuits, etc. So having a total management program in place of all these issues are going to be very, very important, and they're going to be paramount to provide success in retirement for you and your family. And last, I want to leave you with an offer because we're approaching the end of the year. You still have time to do tax planning. And again, based on all the information that we have talked about today, and I could spend 30 to 40 minutes in each and every one of those topics, but because this is a webcast, I wanted to do it as short as I possibly can. I recommend a number of things. Number one, you must, and this is a requirement because no one is going to do it for you. You need to be consistent, and you have to have the principle, and you need to have the ability to educate yourself every single week. Dedicate 2 hours of your life every single week and 2 hours of your time every single week to educating yourself, because information without education always leads to failure. So my offer to you is the following. Reach out to me. I'm going to give you the information at the end. Those of you that are my clients, you know how to get a hold of me without any problem whatsoever. And you're going to have the ability to schedule a 30-minute video conference or phone conference with me or personal meeting with me in which we're going to be discussing your financial situation. These 30 minutes that I give you will be at no cost and no obligation to you. If at the end of those 30 minutes, we agree that it might make sense for us to work together in the future, then we will determine what would be the best way to proceed. So there's no cost or obligation to any of you whatsoever along those lines. Now, if I feel that you are suitable and that you qualify to have our customized tax-preferred retirement blueprint done for you, then I'm going to share with you now what that would entail. Number one, our customized retirement blueprint will be able to do your 2018 tax preparation. So we would have the ability to do your taxes for 2018. On top of that, we're going to be able to do a report for you, which is your tax forward planning report. This is a report that is going to help all of you do tax planning. What are some of the things that we need to do in 2019, 2020, 2021? I do a 5-year tax forward report for my clients to let them know in advance the things that we're going to be doing over the next few years in order to minimize and or eliminate your tax liability in retirement. See, when you do tax preparation, you're looking in the rearview mirror. When I do tax preparation, I look in the rearview mirror, but when I do tax forward planning, I'm also looking through my windshield, so it's going to give you the best of all worlds. In addition to that, as I have just talked a little bit, we will do a Social Security reporting calculation for those of you that will benefit from our customized retirement blueprint. This Social Security calculation not only will determine what will be the best year for you and your spouse if you're married, or for you if you're single, to pull the trigger on your Social Security benefits, but what will that year be, and how are we going to pull that trigger and receive those benefits in a way that we do not have to pay a $0 of taxes. That means all of you will be receiving that Social Security benefit totally tax-free, and you're going to avoid running out of money anywhere between 5 and 8 years, and depending on inflation or surviving spouse issues and concerns, as much as 17 years that otherwise you would run out of money sooner. The third report, or other than the fourth report, including our tax preparation, would be a retirement distribution report. You know, most of you have assets all over the place. Most of you have been doing a good job in asset allocation. So when it comes to retirement distribution, remember, it's all about cash flow. And at the end of the day, I measure wealth not by the amount of assets that you may have, but by the amount of cash flow that you have coming to you on a guaranteed basis every single year. So we would put together a retirement distribution report that will give you the best sources of income to pull income from every single year. By the way, when you engage our services, we do all of these reports every single year for each and every one of our clients, because of the fact that we always want to stay ahead and we want to be proactive as opposed to reactive. And then last but not least, we will do an assessment report of what I call the Fatal Four. And the Fatal Four are the four major issues and things that will happen to all of us in retirement as we move forward. The risk of dying too soon, and how prepared are you for that? What impact is that going to have on your family? The risk of living too long, which is totally the opposite. Are you going to run out of money before you run out of life? You know, we have already talked about those issues. We're going to also go into the risk of living with a disability. You know, the fact that you're living a longer life may actually get you quicker to a long-term disability. Are you prepared for that? What are some of the issues and concerns? What are some of the solutions that we may be able to do for yourself and your family along those lines? And then last but not least is the risk of living with eroding factors, taxes, inflation, market volatility, interest rate volatility, and so forth. So when we finalize this customized tax-preferred retirement blueprint, you can rest assured you will be in a much, much greater position moving forward into the future than you would have been otherwise, because you've never had anyone that had been able to put everything together into a package format in order to help you, your business, and your family maximize your retirement income for the rest of your life. And I'll leave you with a final thought. This is a thought that I leave each and every one of you and each and every one of those of you that engages on our podcast and our webcast and our seminars on an ongoing basis, is that my job as a retirement strategist is to help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thanks so much for giving me a few minutes of your time. Hopefully you have been able to take away some of the information and the education that I have provided. And again, if you want to reach out to me, feel free to call me at area code 786-766-1042. You can also reach out to me at Bert, B-E-R-T, at taxplanninggroup.com. Or you can also reach out to me at Bert, B-E-R-T, at or Bert.Salazar at CambridgeFPLLC.com. So again, feel free to call me at 786-766-1042 or email me at Bert, B-E-R-T, at GablesTaxGroup.com. GablesTaxGroup.com. Again, thank you so very much for your time and have a great day.